This is a Goldilocks economy, Charles Payne. You got 2.6% wage growth, and you got jobs of better than 300,000.
And I said participation, participation, participation. This is your best survey. I don't care what survey anybody puts out there, whether it's Morning Consult, whoever puts out these surveys about how people feel about the economy, how people feel about the administration. Nothing tells me more about how people feel about themselves in our country than 800,000 people saying, you know what, I'm going to go and look for a gig this month.
And that's exactly what Joni Courtney said earlier. She said, watch the quits number, because when people quit and go to another job, it shows confidence. Isn't that right, Joni?
Yes, and I think that this speaks to the market, Maria, of what we're seeing from people looking for work, from the demand from our customers. There is a very strong demand for talented, skilled workers in many sectors, many different levels. And this report really, to me, gives a great picture of what's really happening on the front lines of the job market. I expected the number to be good. I'm thrilled to see this number. This also means companies, they're not only looking to make those hires, but they are finding the talent. And I think these numbers can get stronger and stronger if we see people continuing to participate back in the workforce. So to have 800,000 people come back into the workforce is one of the biggest increases we've seen, and great to see participation moving in the right direction.
I know you're going to be poking holes in this, Stephanie. I'm going to come to you shortly, but let me get to John Hilsenrath first, because, John, this market is reacting immediately, up 150 points. What does that tell you about what this does for the Fed? We are expecting the Fed to raise rates 3 times in 2018. The next meeting is March 21st.
Well, I mean, the Fed's going to raise rates on March, but we already knew that. You know, the Fed has signaled that it's going to take things very carefully, and I think this is a pretty good number from the Fed's point of view. You know, they're worried about the labor market potentially overheating, but when wage growth has cooled down a little bit, when people are coming into the labor force, that tells them that they can continue to run this economy a little bit hotter without creating that overheating that creates wage and consumer price inflation. So, you know, I don't think the Fed gets too hot under the collar about this report. My response to, you know, what I said to myself when I heard those numbers was, wow. Yeah. There's just a lot of good in this report
exactly
today.
And my initial instinct said to me, Dagan, Goldilocks. Goldilocks has returned.
Especially with that 2.6% wage growth number.
That's what I'm saying.
Which I suspect, again, it was a lot of these hourly workers who were out with the flu in January.
So that was a great point you made.
That the managers were seeing the pay raises. Let's put this in perspective. Averaging the first 2 months of this year, we got an average monthly job growth number of 276,000 jobs. It was only 181,000 last year for the average for last year. This is an economy that is healthier, that is picking up steam, at least moving into 2018.
White House is going to be out in force today talking about these numbers, Stephanie Pomboy. What do you say?
Well, that 12-month average that Dagan talks about brings us back to about where we were at the peak in this cycle in 2015, which was around 270,000 jobs annually. I think it'll be interesting to look in terms of the impact of construction and weather there, in that could have been, you know, a stronger contributor.
61,000 workers on construction.
Right, and that could be from we had a milder February. I mean,
you think we could have seen an even better number there, is what you're saying?
No, I think that probably was stronger than one expected.
Okay, biggest increase in nearly 11 years.
The other thing I would note is that's a pretty sizable gain in manufacturing employment, and normally manufacturing jobs being higher priced jobs boost wages. So when you see an outsized gain in manufacturing employment, it's normally associated with a hotter wage reading than we got. So there's something going on there that's a little disconcerting.
Yeah, well, that has to do with Amazon, actually, because if you go down to Alabama, they can't even find enough forklift drivers, and you're seeing all of a sudden that manufacturing jobs are in vogue due to the Amazon effect.
I'm glad you mentioned that, because Amazon has created disinflation.
Yeah, of course, because prices have gotten cheaper. Now, that's why we had a big worry in the first quarter GDP number that came out, because what happened is that the dollar got weaker, and then our imports got costlier on a lot of the textiles.
This monthly job growth number is higher, 13,000 jobs higher than even the highest estimate from economists.
This is good.
That's how much of a blowout number it is. That nobody saw it that strong.
It's a blowout.
Yeah, I mean, I think a lot of people were well over 200 because I was thinking well over 200 too, but 300 no. But here, I think first of all, let's talk about the initial reaction. The market could close anywhere, but we were down 50
200 points right now.
So we're down 50 points going into. And the conventional wisdom is if the number was too hot, the market was going to crash.
Right.
Well, that wasn't the initial reaction. This is a win for America. Let me tell you something.
Because the wage number, they see a 2.6% rate wage number. They rally.
Again,
By the way,
Wall
January
Street
was
is
revised lower in the wage number. So initially it came in at 2.9%. It was revised lower to 2.8%. So again, that takes some of the pressure off these markets.
Good point.
If you're worried about
again,
You're exactly right,
It's antagonistic. What Wall Street wants and what Main Street wants are totally different right now.
I don't think over the long run it is, though. I think ultimately earnings move markets, and ultimately you can't have great earnings unless you're growing the top line organically. We're seeing that. We saw that in the last earnings period, and it comes down to the bottom line. And I got to tell you something. This is, forgetting about Wall Street shenanigans for a moment, this is infectious. We keep talking about the Fed. What the Fed could not accomplish was a so-called virtuous cycle, but it is back. The virtuous cycle is feeding on itself in a natural, organic way, not artificial, not pumping trillions of dollars into banks where they park the money and offload their bad debt, but getting money into society where people feel better about themselves.
Yeah, you know what I love? I love to look at this wage number, and what I want to know, Joni, is where are the wages highest? Where do you see the jobs that are actually commanding high salaries right now? Tell our viewers where that is.
Well, if you look at the hourly wages that are really moving the needle here, a lot of it is in transportation, logistics. There's a strong demand, and we've seen a lot of movement in those areas. Of course, though, on the higher side of the professional service sector, you will see, IT, engineering, finance and accounting jobs. Those wages are also moving in the right direction because of the demand. And then healthcare. Healthcare is also one of the hottest jobs out there. So when you look at total job openings, we have 5.8 million job openings in America right now. Two of the hottest areas are transportation and healthcare. They have the most job openings and the strongest demand for talent, for skilled talent in both of those sectors.
Yeah, Kevin, the unemployment rate stays at 4.1%. The last time we saw unemployment this low was late 2000, but at that time wages were up, wages were rising.
Yeah,
more than
exactly, and that's why it goes back to, we're at this unemployment rate, but actually going back to the jobs, this tame 2.6 number really gives cover for the Fed to stay on the path for 3 rate hikes and not 4, and that's why you're seeing the market move, because it was solely focused on wages, and having a tepid kind of 2.6% number lends credence to a 3% guidance as opposed to 4 rate hikes.